setup, and I think I can speak for the entire management that we are delighted to see everybody face to face. So here's to more of that. But welcome to everyone joining us on the live stream on our social channels as well. Without further ado, I want to introduce the management to everyone that's watching us in person and virtually. Rajesh Gopinathan, MD and CEO. COO, NG Subramaniam, fondly known as NGS. And Samir Seksaria, CFO. We'll, as always, start with Rajesh giving the opening address. Rajesh, you can come to the podium.
Am I going to see it here? Will it be visible here? All right. Once again, as Kritika said, it's fantastic to see all of you back here after 2 very unexpected years. And I hope that this is something that we will continue going forward. So thank you for joining. I'll quickly go through our results for both the quarter ending March as well as for the full year. And then we'll open it up for questions as normal. We have had a very good quarter to close FY22. Q4 has ended with us crossing a big milestone in our revenue growth trajectory. We are crossing 50,000 crores for the first time, ending the quarter at 50,591 crores of revenue, which represents a growth of 14.3% on constant currency terms and 15.8% in reported rupee terms. In dollar, revenues came in at $6.7 billion, which is a growth of 11.8% on a year-on-year basis. Operating profit margin has been steady at 25%, and we are finishing with an operating profit of 12,628 crores. Net profit has also been fairly range-bound at 19.6%, and we are having a net profit of 9,926 crores. Our cash conversion continues to be very strong. This has been a quarter of very good collections. Our DSOs is at an all-time low. And we have ended the quarter with cash generated from operations of 11,000 plus crores. We are ending with cash balance of about 56,000 crores, cash and invested funds. So overall, from a financial perspective, a very strong Q4 to end the year and to close out a year that has been marked by a steady recovery. But beyond the financials, the metrics from various other perspectives also looks very good. As you all have been noticing, I'm sure, over the course of the last few quarters, North American growth has been the primary story that has been driving this rebound. North America continues to do well, and we have a 18.7% year-on-year constant currency growth in North America in this quarter, ending at $3.45 billion. UK and Europe continue to do well. UK coming in at 13% and at slightly more than $1 billion in revenues. And Europe coming in at 10%, but off a very high base from what we did in Q4 of last year when we did the transaction with Deutsche Bank. So overall, from a geography perspective, steady growth across all our key geographies, with North America leading the pack. Similarly, from a vertical industry perspective, our largest vertical BFSI, again coming off a very large base in the previous year Q4, still continued to report a very impressive 12.9% year-on-year growth at $2.14 billion. Retail, which was one of the most impacted segments in FY21, which bore the brunt of the early stages of the pandemic, has continued to accelerate through the last many quarters and has ended this year at 22.1% year-on-year basis growth, crossing $1 billion of revenue in a quarter for the first time. So that's again a big milestone in the overall retail journey. In absolute terms, also the first time that they've crossed this milestone. Manufacturing, again, another of the larger impacted segments from FY21, rebounded nicely at a 19% year-on-year growth. When you look at it from customer metric perspective also, it has been a very encouraging set of numbers. Number of customers from whom we make more than $100 million of revenue a year has increased 10 to reach 58. And similar growth across revenue bands is seen across our entire customer portfolio. From our talent and employee perspective, this has been again a strong year of headcount additions, both at a quarter level as well as for the year. We are ending the year with a net headcount addition of more than 100,000 associates at 592,000 associates as we close the year. Attrition continues to tick up on an absolute basis, but from a percentage basis, it is starting to flatten, and we are hopeful that it will start flattening further. In TCS has the industry's best retention rates, and we continue to maintain that lead. Our attrition for the year is coming in at 17.4%. And as I said, we are hopeful for seeing some further moderation of our period-to-period attrition as we look forward into the next couple of quarters. Coming from an innovation perspective, our investments in research and innovation continues apace. We have totally applied for 6,583 patents, and we have been granted almost 2,287 patents, which is an increase of 437 patents granted during the course of this financial year. So again, as I said, very strong quarter with good numbers across the board, whether it is revenue, customer metrics, segmental performance, profitability, cash generated, employee additions, and research and innovation. Across all parameters of our business, this has been a very encouraging quarter, and we're very happy to have ended the year on such a strong note. If we step back and look at the year FY22 in perspective, we have crossed the 25 billion revenue mark in the calendar year 21, which we had shared with you last quarter. For the full year, we are coming in at $25.7 billion. This is again, from an incremental revenue growth perspective, it is slightly more than $3.5 billion more than what we reported in FY21, which is our highest ever incremental dollar revenue growth. In terms of reported dollars, that's a growth of almost 16% at 15.9%, and on a constant currency basis, 15.4%. Operating profit has been quite steady at 25.3%, and we are coming in at an operating profit of $6.5 billion. Similarly, net profit at 20%, and cash from operations, cash conversion rate of 110%, giving us a total cash generated from operations of 42,000 crores in this quarter. The segmental results are similar to what I shared with you for the quarter. North America is the big story of the year. For the full year, they have come in at 17.5% growth, and we are just shy of $13 billion in terms of revenue from North America. Continental Europe, considering it at a year level, comes in at 15% year-on-year growth, followed closely by UK at 14%. BFSI has also performed strongly at 16.7%. BFSI, the services business in BFSI ends at 8.2 billion. And if you consider BFSI across our total gamut of businesses that we do, including products, platforms, regional markets, etc., this year we have crossed $10 billion in revenue from our BFSI customers when we consider it across all our businesses. Again, as mentioned to you and shared with you, the steady growth and acceleration that we're seeing in retail. For the year, they're ending at 20%. Life sciences and healthcare has been one of our most steady and fast growing sectors. And within this also, it held its own with almost close to 20% growth on a year-on-year basis. The patents and headcount and number of customers I've already shared with you. So overall, it's been a very strong year, and we are quite happy about the way we have executed this rebound post-pandemic. We are also happy about the steps that we have taken in setting ourselves up for the opportunity ahead, whether it be in terms of our investments in services, which are starting to pay off, whether it is cloud, digital, security, and various other services that we shared with you along the line. We have also, as we have shared, rolled out our new operating structure, which is further designed to double down on the customer intimacy that we are very famous for, and to make sure that our engagement with our customers is very strongly curated to the stage of their journey with us, and so that we are able to appropriately position TCS across the full spectrum of customer engagement journey. So we are very encouraged by the numbers that we have here, and very optimistic about the opportunity ahead, and excited about pursuing it fully as we look forward into the future. With that, thank you again for being here. We are always open for questions. Thank you.
And on that note, we'll start the question and answers. So following tradition, the first question from Sajid Mangat from Quintillion Media. Sajid, 2 questions, please.
There are 3 people here.
Sajid, continue.
Good evening, gentlemen. You ended the year with the highest ever TCV of 34.6 billion and a growth rate of mid-teens. Looking into FY23, as you have a good order book in your on your side, how do you see the revenue growth going into 2020 FY23? On the question of margins, the Q4 margins were stable at 25%, but are you still looking at the aspirational margin band which you've been talking about, and what are the levers that you have to take it forward? Because if you look at the last 6 to 8 quarters, it has gradually come down to 25%, with the year ending at 25.3%. NGS, on a BFSI side, on a quarter-to-quarter basis, though we haven't given it a release, but I think it's grown by only 2.3 or 2.4%. Why is this slowdown happening in BFSI? Is it a seasonal thing, or where is it coming from?
All right, Sajid, we'll try to remember all of them. Coming to the deal pipeline, as you rightly pointed out, in fact, I missed mentioning that in my opening remarks, but one of the biggest positives in this quarter has been the total volume of deals signed. We have a total TCV of 11.3 billion, which includes a couple of very large deals, close to $1 billion each. And that is in line with what we have shared in the past, of the fact that the pipeline representation of large deals has been fairly similar, though when they will close is of course volatile and is hard to predict. Even excluding the very large deals, still the total TCV signed is our highest ever, so at about $9.5 billion. So overall, the demand environment continues to be very strong. There is a very strong market acceptance, or our services are resonating very strongly with the market, and the investments we have done in that space is coming through very strongly. Beyond that, I don't want to comment about the specifics of where what the likely numbers for growth are, but the momentum is strong, and we are quite positive as we look forward into the coming year.
Digit growth going to be there in FY23? Are you going to target that, and will you be able to achieve the big deals which we saw in FY22?
So we've done more than 15% this year. So double digit seems to be, that's hardly an aspirational target to put out, so I would not like to comment about it. I wouldn't like to comment about it, right? We'll go with what we have, but it is a very positive exit.
Coming to the margin question, Sajid. So our margins in Q4 were flat at 25%, and as you mentioned, 26 to 28 remains our guiding beacon. So our long-term cost structures are well placed for us to deliver within that target band, and in the medium term, we will ensure that we'll double down on our operating levers to come as close to the band as possible. And in the short term or near term, we would expect some volatility to continue. Your second question was in terms of what are the levers which makes us comfortable into looking for that band. I think there are 3 or 4 levers which I'd like to call out. The first one would be better realization, and that would be a combination of improved pricing on incremental engagements. Also, we'd look towards better portfolio mix in terms of pricing, and we have talked about operational slack. We'll look towards reducing the operational slack. The slack has come in as we have been driving towards the growth. So that's on the better realization part. Second one is on in terms of the operating levers in itself, automation, productivity, as well as looking at as the churn flattens out, we'd look towards doubling down or looking at optimizing the fees to external consultant part of it. Last, as we have always said, that we look forward towards support from currency, and that continues. And the biggest lever, which I should talk about, is growth. And growth always remains a lever. As far as growth continues, we should be comfortable operating within the margin bands.
Okay. On financial services, Sajid, as Rajesh mentioned, crossed about $10 billion across our services, products all over. So in that sense that, it's a very large portfolio, very large base, as well as we are the largest provider of technology services to the financial services industry. The growth this quarter, you need to probably look at it from what we did in Q3. Q3, we had a very solid growth of 4% nearly, in banking financial services in a seasonally weak quarter, right? So, I think you need to look at it from that perspective. We've got some fantastic deal wins this quarter, and the momentum is good. The banks across the globe are doing really well, and so we don't see anything challenging per se from a technology spend perspective in the financial services space. I think it's a seasonal adjustment is what I would call it between Q3 and Q4, and we should see the momentum picking up again in Q1 onwards.
Thank you. Next question from Reema Tendulkar from CNBC TV 18. A quick word to everyone. Now that you have the management in front, you can ask your questions one by one. It's just easier that way. It's difficult to remember. Reema?
Thank you, Kritika. And gentlemen, congratulations on another robust quarter. Rajesh, my first question is on the order book. It seems that the order book, as you said, is a culmination of some of the deals which were already in the pipeline, and it's a timing issue. Is there any read-through on the sustainability of these kind of order wins for the future? And secondly, can you tell us what is the approximate growth in the technology budgets of your clients? Because increasingly there is a worry that while the clients may be willing to spend, they may be constrained by their ability to spend, given the cost pressures that they're also facing. So your thoughts on these two?
Thanks, Reema. As I mentioned in the earlier answer, the large deals that constitute part of this 11.3 that we are reporting, they are very difficult to predict. They are equally present in the pipeline. We have a few that at any given point in time, we have a few that we are working on, but it's very difficult to predict it. But I think the bigger thing that to look at is that the trend line on the TCV is very steadily growing. So we used to be in the 6-7 range, and we are now well into the 7.5 kind of range. So that is what we look at from a management perspective, and that's the more important one for us, because that's the sustainable path, which does not have a dependence on any given one single deal.
Now is 8.5?
Absolutely. I think we're quite comfortable in that 8+ range, and we think that will be that's the long-term one. But again, remember that these are volatile numbers, but it has been steadily going up. So that's the view on that. 11.3, when will it again happen? We don't know. But just from an internal perspective, we're very happy that even if you remove the two big deals, we are still at 9.5, which is higher than the 9.2 that we have ever achieved. That was the highest ever, including large deals. So that's just makes us feel good. To your other question, that Are there budget pressures? Yes.
And the tech budget growth.
In fact, if anything, what has happened in the pandemic side is that the tech budgets are getting prioritized. So yes, there is a cost pressure, but tech budgets are getting prioritized. Even when the semiconductor shortage came about, the solution to that came through technology. With geopolitical tensions, supply chain rebalancing, adaptive supply chain systems, inventory prioritization, these are all technology-led interventions. So typically tech budgets are getting prioritized. If there is a large-scale squeeze, everybody will follow through. But very clearly now technology, from adaptability, agility perspective, from resilience perspective, from security perspective, technology is a priority spend area. So overall, we are vigilant about what is going on in the market, but the trend is positive. And I think that technology budgets will be among the last to be slashed
Squeezed.
when the squeeze happens.
Got it. Samir, if you could tell us about the pricing improvement that you've seen this quarter, and you did allude to both headwinds and tailwinds on the margin front going ahead. But directionally, the street thinks FY23 margins for the industry could be lower, and even for TCS. Do you think that is a realistic estimate? And NGS, in case I don't get a chance to ask the third question, if you could give us a breakup of that $11.3 billion of deal wins in North America, BFSI retail, as you'll normally do, and also any sectors where you see headwinds, like for auto, the chip shortage continues even today. Thank you.
Thank you.
Sorry, I'll answer your second question because I've forgotten your first question already. I'm sorry about it. Pricing, okay. So pricing, so I'll answer that one first. Pricing for the full year has been positive. It's realization which has been positive, and that has a base effect also coming in from FY21. For the quarter, our realization and pricing has remained stable. Coming to FY23, I think I have charted out in terms of what we expect from a tailwinds perspective. The headwinds are known, and it's across the industry. So it would be fair to assume, and as I said, we would expect short-term volatility to continue. In the near term to long term, we are very confident that we will be able to get through on our targets. As I said, short term, we would expect volatility coming in. So that's the direction.
Overall, deal wins have been broad-based, across verticals, across service lines. We are very pleased that the products and services mix of TCS is staying very relevant to customers. North America led the overall deal momentum, and I think close to about 5.7 billion. 6.5 billion. Out of the 11.3 came from North America. BFSI, again, is one of the top performers from a deal momentum perspective. It's about 3.7.
3.1.
3.7, I thought, but 3.1 to 3.7. But I think you'll see it all this in the detailed fact sheets that we have given. So overall, we are pleased that, it's broad-based. Retail continues to do well, and technology services continue to do well. Life sciences continue to do well. It's a very, very broad-based growth. And even minus the mega deals, as Rajesh mentioned, that we're pleased that it's about 9.5 billion overall. That stays well for us in the coming financial year.
And any sectoral headwinds?
Not really. Except that, look, some of the regional markets and the platform business that we have, we see some volatility, continue to see some volatility. But otherwise, everybody, even in a squeeze situation, as Rajesh mentioned, that the technology is the silver bullet, right? So in that context, that we see that everybody is investing in technology. And it's, if at all, it is constrained only by the way that they want to execute it, the way that they want to embrace the change and the talent that they are trying to acquire from partly in-house, partly from outsourced services. But otherwise, there are people who go out, press the accelerator, and then pretty open to embrace everything. Then they get it done faster. There are others, who are, chosen a different approach to do it. Probably they take a little bit longer to get that done. But otherwise, the tech spend per se is always getting prioritized.
Do I go next?
Thank you. Anisha from ET Now.
Hi, Sameer, NGS, as well as Rajesh. Thank you for having us. It's good to be back. Rajesh, first coming to you on the attrition, 17.4% versus 15.3% that we had reported last quarter. You did mention that it's moderating a tad bit, but will it get worse before it gets better? Should we expect a couple more quarters of supply side issues?
Yeah, the reported number of 17.4 will get worse for the next couple of quarters just because of the way LTM attrition is calculated. But what we are seeing is that on a month-on-month basis, we are starting to see flattening of it. So in absolute terms, our attrition still went up this quarter compared to last quarter, but in percentage terms, it has actually started to flatten. And we think that that trend will continue into next quarter. So we'll have to wait and see, early days yet, but the curve is definitely flattening.
And Sameer, on the margin, if you can provide us the waterfall in terms of which were the tailwinds, headwinds in terms of currency, backfilling, attrition, etc.
Sure, Nisha. So in Q4, as I said, our margins were flat. In that, there was a 70 basis points impact due to tactical interventions which we have done through the quarter. And there was a further 20 basis points impact due to increased usage of external consultants. This was offset by 10 basis support from currency, and balance was on account of operational efficiencies which we got across various line items. I'll give you since you have asked, I'll give you the full year waterfall as well. So our FY21 margins were at 25.9, adjusted for the one time which we had, else it was 25.1. And FY22 margins are at 25.3, and that's a drop of 60 basis points. Of that, 230 basis points is on account of increments and tactical interventions which we did through the year, and 100 basis points was on account of increased usage of subcontractors or external consultants. We got 30 basis points benefit from currency, and balance was operational efficiencies, which were mainly on account of pyramid, productivity, and offshoring.
Okay, thank you so much for that. NGS, you mentioned that recovery has been broad-based, a lot of sectors are seeing growth, etc. But is it coming with better pricing? He did hint that quarter-on-quarter it is flat, but going forward, is deal momentum expected to be with better pricing? And also, are you seeing any impact of geopolitical tensions, because Europe this time has slowed a tad bit on a quarter-on-quarter basis? Is that something which is going to sustain for the next few quarters as well?
Overall, there is a stable pricing environment. I think you need to look at it from a perspective of, the volatility that is there in terms of the pandemic. And then, if you look at Europe per se, they handled the Brexit, they handled the COVID in different parts of Europe. And as well as, the sustainability is a big time agenda, right? So there is a stable environment on pricing. In pockets, we see, pricing going up, and certain services of ours, certain programs of ours attracts a much higher pricing. And if you are able to deliver well and deliver it ahead of time, that is a kicker, right? We are seeing those kind of structures getting discussed. But overall, Europe, I should say that because of the reasons that I explained, there is a, if you say stepping back, and then for customers to see, look, there is a war situation, there is a COVID situation, is it gone, is it not gone, right? But at the same time, we all want to, there are countries who have decided that we will live with COVID, coexist with COVID, business should go on. There are some who have decided something the other side. So overall, if you really look at it, there is a slight, stepping back. But I should say backing up is not backing down, right? So it's a certainly, very positive thing we see across our customer base. Europe should really, on a year-on-year basis anyway, it's about 15%. But then, there are some, the indications are that there is a volatility in certain countries. But I think it should normalize out, and we should see a much robust growth in FY23.
And before I hand it over, Rajesh, you said 17% growth is what you already delivered. Is the next target 20%? And I'm going to try my luck. Any timeline that you can offer for that 26 to 28% margin band?
The second one is because we actually ended last year in that band. So it's been not that far away that we were in that band. But overall, no immediate visibility. Considering everything that else has happened, I think we are quite happy with where our profitability is right now. And our belief in sustained profitability and our focus on profitable growth is very, very clear. So we will keep focusing on that. And that's where the confidence comes from. But no timeline perspectives. Growth-wise, again, we don't like to comment about specific numbers. We're sharing with you the pipeline, we're sharing with you the momentum. As I said, we added $3.5 billion this year in incremental revenue. We are exiting at a run rate of, I think, 27 billion or so. That's where if you take Q4 into. So there is good momentum and we'll build upon that.
And just to get our expectations right, $11.3 billion worth of TCV, is that a sustainable number at that level? Or as you pointed out, it'll fall back to $8.5 billion?
Definitely it'll fall back on the next thing. But we do have decent spread of large deals in the pipeline. And so, will it be 11.3? I can't say. But definitely it'll directionally, we're quite confident that the base level will keep on moving up.
Thank you. Ashish from PTI.
So just a small one. What are the short-term volatilities which you foresee actually, and how do you look at the entire crisis in Europe playing out on the business? Like, because probably you might not have so much of exposure to Eastern Europe or Russia per se. Maybe not so much of staffing as well, but still.
So overall, we are very concerned about the tragic war that has unfolded and continuing in Europe. However, luckily we don't have any operations, no employees, no direct operations in any of the impacted countries. We're staying very vigilant about it. We are trying to see how we can help our customers who are impacted by it in their BCP operations. We are trying to also step back and say that as customers try to decouple their operations and their supply chains, what is the support that they need to be able to execute on it. So we are quite engaged in the whole process, though at the first level impact for us is almost, or we don't have a direct first level impact, but we are very engaged in the whole process of what is unfolding. But it's very tragic and we hope that it, some amount of stability comes back into the region. We are also very active in the relief and reconstruction efforts that are going on. We have directly contributed about €1 million to relief agencies in support of various relief work through NGOs. And we also have a program of one-to-one match of contributions from our employees. So companies will match one-to-one whatever the employees' contribution is. So active engagement from CSR perspective into it. So multiple ways we are trying to do whatever we can do in the situation that is currently unfolding. From a business perspective, it is very difficult to estimate what the impact will be or how it will play out. But as I said, we are staying very close to our customers and making sure that we can help in whichever form that we can. And that we'll have to wait and see how the situation unfolds.
If just a small follow-up on that, any sort of initial conversations with because we have seen quite a lot of sanctions on payments. So any sort of conversations around because the entire order as we knew it is sort of falling. So from a tech perspective, any sort of conversations there? And secondly, also on the commodities side, wherein in the past episodes of crude price hikes, we have seen some impact. So do you see anything happening there as well?
In first order impact is very low for us from a commodity perspective, etc. That of course has cascading impacts in terms of both opportunities as well as challenges in our customer universe. And we'll have to stay nimble to make sure that we're participating where the opportunities and minimizing the impact where the challenges are. Otherwise, overall, I think there's a great focus on security and resilience. And we are trying to make sure that we can work with our customers in as they think through what it means from a security and resilience perspective to take care of a very, fluid and fast evolving situation.
Thank you. Ramita from ET Paper.
Thank you. So one thing that a lot of analysts have been talking about is that almost, I think 60+% of the new deals coming into the market are from the below 20 million kind of range. What is, the spread like for TCS? And also, if you could give us some color on how the company is kind of growing this or kind of helping this smaller group of clients to kind of evolve into your larger long-term client base.
Robita, we have not seen a significant shift in the nature of the order pipeline, and we have spoken about it multiple times. And I think this quarter's TCV actually underlines what we have been saying for many quarters now, that in a given quarter, whether there is a very large deal or not is not a reflection of what the pipeline is, and that in the nature of it. So I don't think there is any significant migration towards smaller deals or larger deals. Pipeline remains quite evenly distributed from a time perspective. That is, it's a similar distribution that we have always seen. So, and that's something that we have always maintained. And as I said, this quarter further validates our stance on it. What was the second question about?
Just how do you plan to kind of grow the smaller clients evolve them into a larger long-term relationship?
All right. So one clarification is that deals don't translate to client sizes. We have very large customers who do give us quite a lot of small deals also. We have small customers who give us large deals also. So these are two independent variables. But we are very focused on lifetime value of our customers and helping the customers in this journey with TCS. So we are one of the most in terms of client mining and continuous investment into our existing relationships so that we can grow the total value of the relationship, which we believe is net beneficial both to us as well as for the customer. We are doubling down on that with our new structure. And the new group that we are bringing into focus called the RIG group, the Relationship Incubation Group. Their mandate is specifically to take customers in the early stage of their journey with us and to accelerate their journey so that they become larger level relationships. Towards that, we are investing in greater customer intimacy, greater frequency of contact, greater frequency of relationships, as well as also simplifying the way they see TCS, so that while TCS itself is a complex organization and there's a lot of value that they deliver to a large relationship, for a smaller relationship they should be able to see it as a single point. And that's the role of RIG, that they bring the best of TCS to bear in that relationship and accelerate it. So that's the investment that we are doing to further accelerate this client mining.
Got it. And just one follow-up query would be, what is the plan for fresher hiring for FY23?
So we are going to continue to maintain the momentum that we have had last year. But our approach, because we have invested into creating this unique market-leading infrastructure, which we call the NQT, our approach is to go agile on it. So last year we had said that we are targeting about 40,000 odd fresher hirings. We ended up substantially higher than that. We are again starting this year with a similar kind of a target, but knowing that we will be able to keep on moving it up as we go along. So the NQT gives us a unique platform that we can continuously tweak it and stay very close to where the demand is. The hiring can be tweaked to that. So we will leverage it. But the stance is similar to last year. So the starting points are going to be similar to last year.
Thank you. Shivani Shinde from Business Standard.
Hi, gentlemen. Good evening. Congratulations on a great set of numbers. So, Rajesh, I'll start with you. You made a comment about the new structure that you are putting in place. If you could elaborate a little bit more on it, and in terms of the impact that you want to create, and by when do we see that on the numbers as well?
Shivan, it's similar to what I said, that our philosophy has always been to invest in our customers. 98% of our revenue comes from existing customers. And it has been about growing the size of the relationship. And as customers go through different phases of their relationship with TCS, what they expect of TCS and where the value creation is keeps changing. So at an early stage of the relationship, it is about executing that given engagement very well. And it is not about bringing the entire complexity of what the organization can offer onto it. It's very focused. It could be a transformation engagement, it could be a delivery engagement, it could be a maintenance engagement. But whatever it is that the customer has entrusted us with at that point, it's about establishing the trust, establishing the working relationship, smoothing out the interaction processes. So the RIG group is focused on that, right? They are focused on delivering that one value that the client has chosen us for. As the customer relationship grows, typically our target customers trying to gravitate towards a few strategic vendors. They go through vendor consolidation exercises. They want to have a relationship with vendors who have a full spectrum of services so that they can actually consolidate into a few strategic vendors. And the second stage of our relationship is always to do that, to try and occupy that trusted position of a strategic vendor with our customers across our full services. And the next stage obviously is that as a strategic vendor you have the scale, but then how are you relevant to them across a wider spectrum of their transformation agenda. And that again is a incrementally different set of focus areas that come, because you have earned the trust with scale. Now you need to earn the trust in terms of the strategic value add in their transformative agendas. These are not mutually exclusive. This is about setting up the organization structure to be optimized to deliver what the customer is expecting. And different customers are at different points of the journey. That's why we are saying this structure is curated for the customer journey. And that's where we are looking at it. It is not a segmentation based approach. It is a customer journey based approach, which we believe is first of its kind in the industry, or actually wider also. So typical segmentations are about small customers, mid-market segments, enterprise segment. This is not that. It is about our relationship with the customer and how it progresses through this sequence, where every customer we hope to be able to take through the same journey.
And it's already operational. It is already operational.
April 1st, it's operational.
Great. NJ's question, it's actually a follow-up to what Rima had asked. So if we have to look at Q3 and Q4, and if you have to look at the TCV of 11.3 billion, you're saying it is the timing of the deal closure that is more significant, especially the large deals. And is that going to be, is that what we'll see in the coming quarters as well?
See, the large deals, it has its own journey, right? It takes sometimes, 3-4 quarters or sometimes 2 years to shape that such large opportunities that they want to have it. So at any point in time, what we call as the mega deals, right? That will come and then it will add to our stable, let's say, deal closure performance, right? So in that context, I think, compared to Q3, Q4, we had these 2 mega deals, which actually, took us to the 11.3 number, right? So minus that, we are in that same trajectory, right? Typical trajectory we are comfortable with, and that's something that we want to maintain it, sustain it, and if possible, improve it with a lot of small, medium, large deals.
One more question on the hiring numbers. Would it be fair to assume that FY22 you're closing with around 100,000 just campus hires?
In
FY22.
Yes. We had 100,000 freshers joined TCS during FY22.
And that's the number that we will see for FY23 as well?
FY23, we're going to start with 40,000 as we did last year. But then, the model of hiring that we had put in place through the NQT, TCS National Qualifier Test, that provides us the mechanism to stay agile and then see, based on the market demand and based on how we see the opportunities coming up, we could quickly ramp it up or ramp down, right? That's the opportunity that we have. So we going with the same thing as the last year, we'll committing to 40,000, but then, as things progresses in Q2, Q3, we will adjust our hiring of freshers accordingly.
Final one for you, Samir. For annual numbers, so what about the plans for capex, especially with now employees getting back? Do we see the spends going up for the next year?
Sure. We through the pandemic also, we have been having our capex quite steady. We have been spending about 3,000 crores on capex, both last year and this year. And we believe we would continue it. The thing to watch out for is during the pandemic, what we did is while we continued to invest on physical infrastructures, we diverted our spend on the technology part, mainly on mobility, digital workspaces, security, etc. As we move forward, as we return back to normal, we will rebalance our spend again.
Thank you. Next question from Debangana Ghosh from Hindu Business Line.
Thank you. So just had a quick follow-up on the hiring target. So now that the restructuring plan is coming in place, will the kind of capabilities that you were looking to hire for going to change or evolve? With any update on that aspect?
So we have been continuously increasing the various levels of capabilities that we are hiring. This should be seen in context of what we are doing from a longer term perspective. We have spoken about our growth and transformation aspirations and targets, and the kind of work that we are moving more and more into. And that capability is being supplied both from enhanced training internally into the contextual masters program, our various other training programs that we're doing internally, as well as targeted hiring from outside. Last few years, we have been one of the largest hirers from the various IIMs and other management institutes. So there is a wider spectrum from which we are hiring to get into the growth and transformation side. So the hiring and the capability definition comes from the GNT focus rather than purely from the restructuring focus.
Thank you. Next question from Joshelle Mendonca from ET Prime.
Hello, sir. I have two questions. One, sir, could you break out what the platforms business did in this year? We've had Ignio and Optumera. Could you just give some color on how that as a segment performed in FY22?
Overall, products and platforms has continue to do very well, right? TCS Banks, from a financial services perspective, has done exceedingly well this quarter. Very good set of wins from across the globe, both in the emerging markets as well as established markets. A lot of tier 1 financial institutions, 3-4 of them have selected our platform during this particular quarter. Likewise, Ignio continues to do very well and establishing itself as the #1 platform in the AIOps space. So we are seeing some good deal wins, good momentum. Optumera and retail set of products, it has its own wins, but it's not a very great quarter for them this particular quarter. But there is a set of pipeline opportunities that we see, right? Coming to the large insurance product and platform space, again, we are currently executing the major transformation programs that we contracted in the previous financial years. There are opportunities that we are working on, which will hopefully, bounce back the whole products and platforms performance in the coming quarters.
A couple of years ago, Ignio wanted to be the fastest product to get to $100 million in revenue, and I think that was a few years ago. Could you give us an update on what Ignio is doing right now in terms of revenue?
It did, have the tag that, the fastest to achieve the $100 million revenue band, right? And overall, it's hovering around that number right now. But overall, the approach is that as we launched Ignio, initially, the preference of customers were for on-premise engagements. We have significantly moved from the on-premise engagement to the cloud and a SaaS-based model, in the sense that about 95 to 98% of today's sales and subscriptions are all happening on the Ignio cloud platform, right? So when you take it on the cloud platform, so the difference is that you are going on a year-on-year or a quarter-on-quarter consumption-based pricing, as opposed to the lumpy one-off license deals. So in that sense, that if you look at it, that when you say that, look, it's hovering around $100 million plus, the revenue growth, you have to see it in a different context, because there are committed subscription models which has a recurring revenue base over a set of quarters which are going to come. So in that sense, that I think we are very pleased with the way that the Ignio has performed, and the team continues to improve the product, and there is a solid roadmap behind it, and with a lot more and more of AI, ML and deep learning techniques coming in. So I think I'm sure that Ignio will become one of the leading, AI-based products in the world.
And so just to follow up on the Eastern European situation, even though TCS has no first order impact, say from Russia or Ukraine, you do have operations in countries such as Hungary, because Eastern Europe was considered a very attractive talent hub for the sector. So has a situation with, an increasingly belligerent Russia caused some rethinking in terms of that area as a talent hub for Indian IT?
So we are less than 5,000 people in the Eastern European region. Our largest operation is Hungary, and we have then presence across some of them. At that scale, I don't think there is a major issue, and we have always seen Eastern Europe as a location for scale in this range, right? A few thousands to 10,000 kind of numbers. So I don't think that strategy is in any form impacted. And our approach to Europe has always been to create a network of delivery centers across various hubs, including Ireland. So, Ireland, parts of Eastern Europe, parts of Western Europe itself, smaller hubs in Hungary, etc., and Spain. So that strategy is overall not directly threatened by what is going on.
If I can add there, Joshel, that in the Eastern European, as Rajesh mentioned, we have hub is Hungary, but we have operations in other parts, right? We have in Slovenia, Slovakia, Romania, Poland, all this. In the current context, there are quite a bit of migration that takes place, right? So talent availability is good and improving. They're all looking for jobs, right? So one of the things that we can do and be meaningful to the communities there is to see whether there are opportunities that we can bring in to those centers and increase our local hirings and create jobs locally in that part of the world.
Thank you. Next question from Shubhra Tandon from Financial Express.
Yeah, just wanted to understand, sir, about the hiring. Is it all from tier 1 institutes, or are you looking at, how is the momentum from the tier 2, tier 3 colleges? Is that, producing enough talent that you can hire?
We have been significantly democratizing hiring. So for the scale that we hire, while we continue to be preferred employer at all leading institutions, but the approach to NQT has been to democratize hiring. So on NQT, it does not matter where the student is coming from. And we are quite happy with the kind of results that we are seeing, where unknown institutes also are producing students who are doing very well. And since it's a standardized test, we're able to compare them across And we are finding very good talent from previously places that we don't. Typically in a given year, we visit about 300 odd campuses in our old model. We used to have about 500 to 700 campuses that were kind of certified, and we would visit about 300 odd in any given year. Now we are recruiting from more than 1,000 odd institutions because it doesn't really matter. It's a common test. So it's a complete game changer in the approach and the kind of supplies that it unlocks for us, because we are able to reach students from Northeast, many other places that were earlier inaccessible, sheerly because of the logistics of the whole hiring process.
Thank you. Next question from Anurag Shah from Z Business.
Yeah, Namaste sir. Sir, you just said that attrition will become plateau going forward. So what would be the reason behind that? Because we are seeing that IT is the only sector in where wages are going up only, unlike in all other sectors. So second question will be, sir, that your work from home policy got so much of talks all over. So going ahead, are you sticking to the same policy, or there will be some other changes because you had a 2-year altogether different experience?
Yeah.
And yes, sir.
So on the attrition aspect, the way to think about this attrition is that if you look at TCS's own approach, when the pandemic struck, we took a very strong stance that A, we will not lay off anybody, and B, we will hire all offers that we had made, and we will onboard everybody that we had made an offer to. So we maintained our hiring, especially at the entry level, through the impact of 2020 when the biggest impact came about. The industry didn't necessarily react that way. There was a fair amount of flux in the industry around the early part of the pandemic till end of 2020. Our industry is a long cycle on hiring. So what we really are seeing is the lag effect of the lack of hiring that happened in the industry, which is why there is so much of churn where people are trying to hire away from each other. So demand exploded, whereas the early stage supply had not been fixed. As we get into this year, we are well into the hiring cycle. So the benefits of last year's enhanced hiring will actually start reducing this incremental impact. So that's where we think that structurally hiring attrition will start tapering off a bit as we get in, and the supply from last year starts coming fully into the system. So that's where where our expectation is. And in terms of on ground, as I said, while attrition is still on an absolute basis going up for us, but it's going up at a slower rate than what it was earlier. And on a percentage terms, it's starting to plateau. So hopefully by the time we get to June, we should see that we would have crested the peak of this curve.
On the
yes,
work from home.
Yes. So there, I think we have tested a model which came about in a term of very extra fast speed, and we are quite confident about the 25/25 model that we laid out. But it has to be implemented in a structured way. So we are currently operating at almost like a 95/5 model, and we need to get back to a more normal model of 80/20 or so before we start the migration to 25/25. And hopefully, if the trajectory that we are currently seeing continues, we will start accelerating that shift back to that 80/20 model. We are starting with our senior associates, the top 50,000 odd people, who will start coming to office starting 3 days a week from this month itself. And then we will be continuously increasing the coverage of associates who will start coming back. But we will take it gradually so that the system can adjust to that shift and get to a stable point. So sometime by middle of the year, we should be somewhere in the, well on the way to the 80/20 path.
Yes, and sir, apart from that Passport Seva Phase 2, any other project, big project you are doing with Government of India?
We have quite a few nation-building projects or mission-critical projects there with the government. Offhand, I don't want to name any one given one, but across tax, across payments, across the national health insurance side, across the board, we have fairly large engagements with the government. Nothing of the current size that the Passport Seva project is, but from an impact perspective, we have quite a few engagements.
Thank you so much.
Thank you.
What's it? Oh, that's on the new gift city. Do you want to? Yeah.
No, it's essentially facilitating the derivatives clearing platform by which it allows, let's say, the Singapore investors or Asian investors hitherto are doing the trading on the Singapore Stock Exchange. They'll be able to do the trading directly on the NSE futures here, and then our software solution is facilitating that plus the clearing of it.
Sajid, we'll take that offline. We're really tight on time. Laltendu Mishra from The Hindu.
Hi, all the questions have been asked, leaving me with nothing. Again, I'll ask for the geopolitical impact on the company. The Reserve Bank of India governor on Friday said there has been tectonic shift that has happened. Almost every economy is getting impacted. As you know, we have raised our inflation targeting for 4.5 to 5.7%. So don't you think there will be no impact on the company at all?
No, I don't. It would be not at all rational to think there will be no impact. I said two things. I said that the impact of it on the demand side is likely to play out in a manner in which technology demand is likely to be the last impacted by the economic impact that is going to unfold, because technology is part of the solution to the problems that are coming through, and that I strongly believe in. The downstream impact due to, if there is a economic disruption, the downstream impact of it will be felt. Inflation by and of itself is not a demand collapsing agent for us. We are not in the financial services industry, so asset price, whether it is up or down, does not necessarily change the demand for technology consumption. And if you look at our our customer base, typically balance sheets are in fairly good condition, so that their ability to spend is not dependent on what the level of the financial market is at. So our view is that from a demand perspective, we think that the impact on this industry is likely to be felt with a bit of a lag effect and will be lesser than what other industries are. It's only a relative sense that I said, not an absolute one.
One more question. What has been the average wage hike last year, that's gone by, and what is likely this year? Thank you.
Last year, I think hikes were in the range of about 6 to 8% in the India market, and this year also it is likely to be similar with a slightly upper bias, but similar kind of a long-term one. What is important is that it varies company to company. As you know, TCS was the first company to declare wage hikes at the 2020 cycle. So the moment in September and October beginning, when we started seeing the uptick, we went ahead and raised our wages in October itself. We were the only company to do that, and we subsequently again did it in April, bringing back the normal wage hike cycle. So we have maintained a very stable and predictable approach to salaries and increments, which is one of the key reasons why our employee satisfaction is also quite high, because people see it's a transparent, fair system. So we will expect, with a bit of a upward bias, a similar kind of wage cycle to play out in the coming year also.
Thank you, Laltendu. That's the end of the questions from everyone joining us in person. We have 2 questions from our friends from the media who are joining in virtually as well. Chandra Shrikant has a question for you, Rajesh. TCS plans for the metaverse in terms of projects and hiring going forward.
We are excited and exploring it in all ways. We are seeing early stage interest in it, both from customers as well as from our employees. At this stage, not much of expectation in terms of what the size of the opportunity is, but given the amount of investment that's going in, we are standing ready to participate. Individually, we are participating in a few places with one of the large telecom service providers in North America. We are helping them reimagine their entire retail buying experience. Similarly, with medical device manufacturer, we are helping them reimagine the approach to training of new medical devices. So different use cases are being experimented with, and we are integrating our design studio capabilities with our digital twin capabilities and our knowledge of the domain to try and bring this together into the metaverse. So overall, it's an exciting space that brings together many capabilities that TCS has, and we are trying to focus it and work on a wide spectrum of use cases so that we can participate in the evolution of this.
Thank you, Rajesh. Chandra has requested another question for NGS. Any incentives to bring employees back to work?
I think it's one is the first of all self-motivation. That's the biggest incentive that I think we can give, right? We just had our customer summit in Europe. We had about 250 of our clients came, and it was good to be there. It was good to hear all of them talk how different it is, right? Likewise, we all are here, and then this experience is terrific, right? Likewise, when we talk to our employees, and many of them felt that I think it's good to be back. Whoever is coming started to come, and the energy that you see when people come to office and then interact. And then the fact is that they have been able to put together something very quickly, and then all the energy that are held back all along, we could see that they're all getting unleashed within a couple of days rather than over a period of time. So I think people will like it, and we look forward to welcoming each one of them into our offices and facilities. I don't think that the incentives are not the way to really bring people back, but I think the experience that you get and what's the difference is going to make to your own way of working, your own building the networks and internally and externally, and having interactions with clients, because clients have started to come. When I think last week we had 3 client visits in Bangalore, and I even had a dinner with one of them. So it's really a great experience and great to be doing that again, right?
And last question for the evening from Ayushman Barua from Mint for Rajesh. How will the new structure play out from a cost perspective, and have you made any specific investments for the new organizational structure?
Our investment strategy continues. I feel, as I said, this is further doubling down on our approach to customers and making sure that we are relevant to customers across all phases of the relationship with us. Specifically on cost, I don't see neither a positive nor a negative impact on it. I think the investments are well within our regular investment schemes. Our focus on investments will be different for each of the segments. We will be focusing much more on local presence and local intimacy on the RIG side of it, the relationship incubation side, as I explained. Similarly, a lot more on the capabilities and the business transformation group in terms of being relevant to their overall transformation journeys. So the approach to it is very different from a cost-based approach. It's about building ourselves up and setting ourselves up right for the opportunity in the long term. And it is a logical evolution of the TCS operating model, and a very exciting one at that.
Thank you, gentlemen. Thanks to everyone here in person. It's great to see you once again. Please join us for refreshments. And to all those joining virtually, we hope to see you next time. And thank you so much for watching us.
Yeah. Please tell me that I can't, that I won't, that I fail, that I'll never make it out, yeah. Please tell me